Hi, everybody. Welcome to Getting Started with Structured Notes. My name is Jason Barsema, and I'm the co-founder and president of Halo Investing. Prior to co-founding Halo in 2015, I spent my career at Credit Suisse, running one of their largest private banking teams for family offices, institutions, and high net worth individuals. Structured notes have always been a very important part of my asset allocations, but I always used to say they're one of the most elegant products in theory and one of the most inefficient in practice. A lot of those inefficiencies came from the complexities of structured notes. They're difficult to manage. They're difficult to talk about to clients. They're difficult to understand. Well, with Halo's technology and education, that is no longer the case. Today, we're going to talk about what are structured notes, where do they go in the portfolios, and how you can effectively talk about them with clients. Let's first think about the challenge. As we all know, if the market is down 20%, your portfolio needs to be up 25% just to get back to par. We realized this last year in 2022 when your average 60-40 portfolio was down around 20%. What are you talking about with clients today? How are you going to get them back to par without taking inordinate amount of risk in the portfolio? That's where structured notes ultimately can come in and help your practice. Case in point, and I love this slide, it just shows the risk that we've had to take in our portfolios through the course of the last 30 or so years. If you look at 1991, we basically had an entire portfolio of cash and bonds just to hit our clients' typical return objective of that 7%. I always focus on 7% because at least when I was managing money, I always asked my clients, what do you want to make in your portfolio? What do you want to do in your portfolio? And there's always two responses. Make me 5 to 7% on my money and do it with reasonable certainty. Well, in 1991, you could hit that 7% with pretty much all cash and fixed income with a standard deviation of around 1%. Now, fast forward to 2021, that fixed income allocation is around just 3%. And to hit that 7% return objective, you've had to take 17 times the amount of risk in your portfolio. That's very difficult as many of our clients are getting older and they're getting to that retirement age. We need more efficient and sufficient investment tools and savings products in our portfolios to help meet our clients' return objectives of 5 to 7% without having to increase our risk like we've had over the last 30 years. Now, ultimately, this brings us into the next phase of the asset allocation evolution. When you start back in the 1930s, all the way really through the 1970s, investment management was really around stock picking. And then came the advent of the mutual fund in the 1970s, which was really cool. And at the beginning, everyone was told Jack Bogle of saying, why do I need a mutual fund when I can buy all the individual shares myself? And the unfortunate part is not everyone could afford to buy every single share of the S&P 500, and thus the elegance of the mutual fund wrapper. But there was also some inefficiencies. And then came along the ETF wrapper in the 90s, and then came along alternatives in the 90s and 2000s. But ultimately, we believe the next generation of asset allocation is really incorporating structured notes, which gives you that upside exposure to an index, just like a mutual fund or an ETF would, with just that comfort of a downside cushion in case the market goes wrong. Also, model portfolios and the OCIO approach are becoming very important. So Halo offers a variety of solutions around these structured notes, around these model portfolios, and an OCIO to be able to have our RIA customers like you be able to help better manage their portfolios, the return objectives within, and of course, the risk that you're taking. Ultimately, this leads in the case and the need of structured notes. We want to be able to get market upside, but do we really need all of the upside of the market? I think if you surveyed most of your clients, they would probably say, hey, I'd like to get 70 to 80% of the upside. I just don't want all the risks that I have to take by just buying the S&P 500 long. That is exactly what a structured note does. In a time where there's a lot of uncertainty on the table, meaning what is the Fed going to do over the next 6 months? What are earnings going to do this season? What about the geopolitical and global macro risks that are occurring all around the world? We don't know. And just as we have insurance on our car because we don't know when we're going to get into an accident, and just like we have insurance on our home because we don't know when something bad's going to happen to our house, that's why we need insurance on our investments, because we just don't know. That being said, being scared about the global uncertainties is not a reason to just stay in cash and not invest. Because if we did that, we would never invest. Find me a quarter where there wasn't some big global macro uncertainty. I can't think of one. And structured notes always gave me the confidence when I was at Credit Suisse to tell my client, look, I don't have a crystal ball and neither do you. But what I do know is I'm becoming optimistic on the market. I don't know if the market's going to turn in a month, in 3 months, or 3 years. But here's a structured note that gives us that downside investment protection in case I'm early, while still allowing us to capture the upside if and when we're right. And it's not just me who's saying that I love structured notes. Yes, I've been using structured notes in my portfolios for 15 years. Yes, 25% of my own portfolio on average is in structured notes. But 1 out of 3 advisors are saying that they're going to use structured notes in the next 2 years. This is really remarkable because just a few years ago, that number was around 7%. So I think the market has forced us, given the interest rate environment, given the global macro environment, given market uncertainty, to think about other products, just as we now think about alternative investments like hedge funds and private equity as a staple within the portfolio. Mark my words, I believe that structured notes will be just as much of a staple, if not more, within the portfolio within the next 3 to 4 years. Now, many of you listening are probably wondering, what is a structured note? And I always say, it's okay. Most people have never heard of a structured note before. And I always joke that structured notes are the biggest market you've never heard of. Case in point, the global structured note market is around a $3 trillion market, meaning there's $3 trillion of structured notes outstanding all around the world. It's not a new product. Structured notes were first created in 1976. And so this is a product that's been around for nearly 50 years. And it's a very big market, not only in the United States, but even bigger internationally for a variety of reasons. In the United States, to put this in perspective, we issue about $100 billion a year in structured notes, compared to Europe that issues around $400 billion a year in structured notes, and Asia that issues around $600 billion of structured notes. Now, there's a variety of reasons why that is, and you can follow up with me offline, and I could tell you about all the history of structured notes until you're blue in the face. But the point is that this U.S. structured note market is growing, and it's growing quickly. About 5 years ago, the United States structured note market was about $50 billion. So case in point, over the last 5 years, the U.S. structured note market has doubled. And again, I think it points back to the need for a more efficient and sufficient savings tool in our portfolios to be able to help mitigate the risks within the market while still being able to capture our clients' return objectives. As we talked about before, structured notes have been traditionally inefficient. I always joke, Google the word structured note and see what comes up. And what you'll find is usually that they're overly complex. You have counterparty risk. The fees are really high. They're not transparent. They're not liquid. Buying and managing the product is like working with a travel agent before it orbits. What Halo has done is really disrupted this $3 trillion market of structured notes by inserting technology both on the issuance side and on the purchasing side to be able to have a streamlined experience that gives more liquidity, gives more transparency, gives more efficiency, and is able to reduce the complexity so all of us can use structured notes. More importantly, our technology has democratized the product. Prior to Halo, you needed $1 to $3 million to buy one structured note. That pretty much ices out 99% of America. We wanted to build a platform that was made for all. And so on Halo, you can actually buy a structured note now for $1,000, which is a really novel innovation. How can structured notes help you? Well, we touched upon this a little bit, but specifically structured notes can help you reduce risk within your portfolio. Again, think of it as insurance around your investment. You have a level of downside protection to protect against the unforeseen in the markets. Structured notes can also help you add growth to the portfolio. When you buy a structured note, you can actually get enhanced upside. So you may be better off buying a structured note than buying the index or the ETF itself. And number 3, which is something that's on the top of all of our minds, is that structured notes can help generate income within the portfolios. And so structured notes can really help lock into this defined outcome for your clients, providing that level of certainty in uncertain times. But moreover, as I always charge advisors, what products are you using? What strategies are you using if the market just goes sideways over the next 2 to 3 years? That's very difficult to manage because, again, our clients don't care, right? Our clients want to make 5 to 7% on our portfolio every year with reasonable certainty. So going to your client in a market where we've had some challenges over the last 15 months, or if we're in a market in the next 2 years that's just going sideways, we have the confidence to tell our clients to say, look, yes, we're taking some of the body blows that the market is giving us, but 20% of our portfolio is protected through structured notes. And a part of that protection actually produces quarterly income streams. So it's a great positive talking point to have to clients in these uncertain times. And it's also a great prospecting tool. Structured notes are actually how I built my business at Credit Suisse because no one was talking about this. Now, where do structured notes fit in the portfolio? Ultimately, I always say structured notes are a bridge to that risk gap between stocks and bonds. And so if you look at structured notes can be really whatever you want them to be. That's the elegance, that's the beauty of the product. Whatever investment thesis you have, you can build in a structured note. Now, structured notes in general fall into 3 primary buckets: full principal protection or capital protection, income notes, and growth notes. Growth notes look more like stocks, as we'll get into in a second. Income notes are those notes that provide that consistent yield, that defined outcome that I was talking about. And full principal protection notes can provide yield or growth, but they're fully capital protected. Those look more like bonds with some equity upside. Very popular in markets like these now as interest rates have risen. Those products actually look a lot more attractive than they do over the last few years. Now, a lot of people ask, how do I get this protection? How do I get this yield? How do I get this upside? Well, at the end of the day, think of a structured note as a candy wrapper. Inside the candy wrapper are 2 assets. One is a zero coupon bond, and one's a derivative package. Together, the zero coupon bond and the derivative offer clients that downside investment protection, and on the upside, offer that either the defined outcome yield or the participation rate in the upside of the market. But at the end of the day, it's a zero coupon bond and derivative. A lot of questions I get asked is, well, can't I go out in the market and do this yourself? Maybe, but there's reasons why you don't. Number one is that most structured notes that people buy, you actually can't replicate in the exchange traded market. There are no listed options for 3-year derivatives. There are no soft protection, as we'll get into. If you want to create a basket within your structured note, there are no basket options in the listed market. But there can also be tax reasons and efficiency reasons. But I always just point back to one simple thing. Yeah, I can go to Best Buy or Fry's Electronics and buy the motherboard and the hard drive and pick my CPU and build my own computer. But wouldn't I just rather buy the Mac? In this metaphor, the structured note is the Mac. Assembling your own option strategy is like going to Best Buy. It's just a lot easier to have one line item in the account. Structured notes are also created by major banks. And so who's creating this zero coupon bond and derivative package? Major banks like a Morgan Stanley, like a Citigroup, like a UBS, like a Bank of America. They're the ones who manufacture these products. So it's really important to know when you're buying a structured note, one of the things that you need to consider is the counterparty risk. The terms only matter at maturity with structured notes, but the terms only get paid out if the bank is in business. So Halo is proud to offer structured notes from a variety of the world's largest issuers. Globally, we have about 30 issuers on the platform. In the United States, we have about 17. So we give you a wide variety of issuers, all very strong banks, all well-known brand banks, and gives you the confidence to be able to have choice. And it also gives you the confidence that you know that you've got price competition when you're buying a structured note with Halo. So yes, now that we know that a structured note is a zero coupon bond and a derivative package issued by a major bank, I always used to educate my clients on 4 simple variables. If you can understand these 4 variables, you can understand any structured note in the market. I don't need to know how the engine's assembled to make sure that the car drives well, right? And so your client will lock onto these 4 variables a lot easier than you will if you're trying to spell out all the derivative math. And don't worry. We have all the content to back up this math, so you can, with confidence, explain that to your client if you need to. But I would really focus on these 4 variables. And the first variable is the maturity date. Like a bond, every structured note has a maturity date. That maturity date can be 3 months to 10 years. You, as the financial advisor, pick it. In this country, the average maturity is 2 to 3 years. The second variable is what's called the underlying asset, or what's also known as the reference asset, meaning the structured note is linked to the performance of an asset. That asset can be an index like the S&P, it can be a stock like Apple, but it can even be a commodity, interest rate, or currency. About 70% of structured notes in the United States are issued against major indices like the S&P 500, like the Russell 2000, and so forth. But again, structured notes can be anything you want them to be. With Halo's technology, we give you 3 billion combinations on our platform. So don't worry, whatever you want to buy or structure, or most importantly, protect, you can do that with the Halo platform. So the second variable is the reference asset. The third variable is the payoff, meaning what do you get? As we talked about before, there's 2 general payoffs: an income note that provides a defined outcome, or a growth note that provides a participation rate. The fourth variable, which is why we all buy structured notes, is the protection amount, right? It's the quote unquote insurance that you have around your investment. And so the terms of the structured note, which is a very important point, the terms of the structured note only matter at maturity. So it does not matter what happens prior to maturity. If you buy a 2-year structured note, go to sleep and wake up in 2 years and see how the underlying performance is doing. Okay? If it has not breached the protection amount, you get your full principal back. If it has breached the protection amount, you're either fully or partially exposed to the loss of the underlying asset, just as you would be anyways, excluding dividends. And so that's really the beauty and the elegance of structured notes. Now let's talk about a few examples. So this is a great example from Halo's calendar page, where we have over 200 choices any given month that an advisor can search through and subscribe at for $1,000 minimums. This is an example of an income note. And so with this income note, what's the maturity date? It's 36 months, 3 years. Okay, so that's the maturity date. What's the reference asset or the underlying asset? This structured note is linked to 3 major indices: the Dow Jones, the Russell 2000, and the NASDAQ. Okay. Now, when you're linked to a basket, you're linked to the worst performing of that basket. So again, in 3 years, you're going to lay all the cards on the table, meaning the Dow, the Russell, and the NASDAQ, and you're going to select the one that's performing the worst. That's what's a worst of basket. So you select the worst performing of those 3 on the maturity date. Okay? I'll get back to that point in a second. What's the payoff of this note? Well, it's about 8% annualized yield. What does that mean? Every quarter, you're going to get 2% cash money deposited in your account. This is a guaranteed coupon, of course, subject to counterparty risk, and the issuer here is Citigroup. So as long as Citigroup is in business, they're going to pay you 2% every single quarter for 3 years. Okay? Now, at the end of the term, which is in 3 years, as long as none of those 3, the Dow, the Russell, and the NASDAQ, are not down by more than 25%, the investor gets his last coupon and he gets his principal returned back to him, okay, because you did not breach the protection amount. If one of those underlyings are down by more than 25%, you're fully exposed to the worst performing of those 3. Now, you might be saying, oh my gosh, well, I thought the point of the protection is to protect against the unforeseen. Well, you can go on Halo and see that the probability of those 3 being down by 25% on the maturity date, which is in 3 years, is extremely low. But of course, anything can happen. And if, hopefully not, but if one of those 3 are down by more than 3%, are you taking any more risk in the portfolio than you would be if you allocated to US All Cap Core, which is where this note would be going in your portfolio anyways? And so when you buy a structured note, think about you're using cash to buy an asset class that you would have bought anyways. You're just buying it with that contingent protection of 25%. So you're not taking any more risk. You would have had the same exposure anyways. And in fact, you're taking a lot less risk because you have 25% soft protection. Now, keep in mind what I said earlier. You just clipped 8% for 3 years. That's 24%. So let's say the Dow is down 30% at maturity. and the Russell's down 10 and the NASDAQ's down 10. Well, the Dow's down 30. That's the worst performing you've reached. So now your principal is down 30. Well, if there's a thread of good news, at least you've clipped 24% per annum in coupons, or 24% over the life of the note in coupons. So you get to offset that loss with the income that you've derived. So if we focus now on a growth note, this gives us upside in the underlying assets. So instead of getting that 8%, you're getting a participation rate in the upside. So again, let's review and go back to our 4 variables. With this specific structured note, it's a 4-year note. It's linked to the performance of the S&P 500. It gives me around 110% uncapped upside. That's the participation rate. And it's got 20% hard protection. Okay, so let's walk through a couple scenarios at maturity. So in 4 years, you're going to look to see what the S&P 500 is doing. Let's just say for round numbers in 4 years, the S&P is up 100% on a price appreciation basis. This note would be up over 112%. Why? Multiply the price appreciation of the S&P 500 by the participation rate, and that's the return of your investment. So again, if the S&P was up 100% in 4 years on the maturity date, multiply it by the participation rate. In this example, your note would be up 112%. Now, on the downside, if the S&P is down 0 to 20, you're down nothing. You haven't breached the protection. Now, if the S&P is down 21%, you're only down 1. This has got hard protection. And so for those advisors who are new to structured notes, I encourage you to consider hard protection because it's a more conservative form of protection versus the last note that we just looked at, which is soft protection. Now, of course, I get a lot of questions of when do I use hard versus soft? Follow up with us directly. We have a full team of Halo specialists that can walk you through the differences between hard and soft protection, or go to haloinvesting.com and you'll see a wide variety of content on when to consider hard versus soft protection. But for those advisors who are new to structured notes, hard protection is a lot easier to talk about with your client because it gives them that comfort of the protection on the downside. Now, when you think about this note, right, think about where does it go in my portfolio? And so I want to introduce to you at least a high level of the Halo model allocation. No, we do not run allocations here at Halo. This is just a sample of, candidly, what my own family's portfolio looks like. The numbers are a little bit different, but what my own portfolio looks like and how I use structured notes within my own portfolio. So we've been educating our advisors on it's not just important to know how a structured note works and how to explain it to a client. It's even more important to know where does it go in the portfolio. And so if we looked at that last S&P 500 note, that would go within my US large cap core sleeve. Why? Flipping back, the performance is linked to the S&P 500. If you bought SPY, where would that go? It would go under your US large cap core sleeve, right? And so this is a structured note linked to the S&P. It's no different than your SPY exposure. It just has downside investment protection. So layered on top of your long equity exposure. And what I always ask advisors to consider is consider about 30% of your long exposure go to the structured note and 70% go to the long equity. So for example, in your US large cap core sleeve, let's just say for round numbers, you're around 10% in US large cap core. If I looked at your portfolio today and you didn't use structured notes, you're probably using an ETF, or you're probably using a mutual fund, or you might be using a tax loss harvesting strategy. No matter what type of wrapper you use for your long equity exposure, if you take 30% of that and layer the structured note right on top, it can serve a really nice purpose, really for 2 reasons. Number one, going back to our previous example of the growth note, it gives us enhanced upside. So if you're passive in your US large cap core, this is a way to actually add alpha within that sleeve because you're getting the enhanced upside. Moreover, is that if the S&P is down, your tax loss harvesting manager, SPY, and your mutual fund will all be down. This gives us that buffer or hard protection of 20% on the downside. So it's almost like a two-way hedge. We have the protection on the downside, and we get the enhanced upside in regards to the S&P 500. And I use this approach, as you can see here, within every sub-asset class within my own portfolio. So US large cap growth, 30%. Large cap value, 30%. Small cap core, I actually do 50% because small cap is more volatile. International developed equities, 30%. Emerging markets, 50%. And it makes more sense to do it throughout the portfolio for a couple different reasons. Number one is we never know when we're going to go off the rails. Number two is it makes our clients feel good because when we go under those uncertain times like we did in 2023 or 2022, we can go to our client and say, it's okay. We've got the protection in the portfolio. And yes, we could show them all the numbers of the science of the protection, but it's really the art of making a client feel good under very uncertain times. And structured notes may make investors feel more confident to stay invested, and it may make investors feel more confident to get invested because, again, if you're early, you have the downside investment protection. But getting back to the layering side, I like to layer these on top of my active managers. No, I am not active in US large cap core, but I am in my small cap core. I believe in alpha and small cap core. I am in international developed. I believe in alpha there. I am in emerging markets. I believe in alpha there. Now, how has that worked out for me over the last 10 years? Not so great, because active management's been very challenged over the last decade, but I still believe in it. And candidly, and I don't give investment advice anymore, but candidly, I believe this is a great market to consider active management, given what's going on in the market and where valuations are. However, I may still be wrong, as I have been over the last decade in regards to active management. However, it's been optically good for my clients when I was at Credit Suisse and for my own family because I layered the structured note right on top. What am I talking about? Well, it's a lot easier client conversation when you say, yes, I'm so sorry, Mrs. Jones, that the manager that I selected is underperforming. I still believe in that manager. But the good news is that we've layered a structured note linked to that manager's benchmark right on top. And why does that matter? Is that we're getting the enhanced upside to make up for any performance drag. And so if the manager underperforms his or her benchmark, we've got the enhanced upside from the structured note to make up for that performance drag. Again, at the end of the day, clients only care about making 5 to 7% on their portfolio with reasonable certainty. So this is a really productive client conversation to have when your active managers are underperforming. Now, assuming I'm right and active management does make a comeback and the managers that I pay actually do their jobs, ultimately, I'm going to get the double bonus of the alpha from the manager and the enhanced upside from the note. Now, on the flip side, if the benchmark is down, as I just mentioned, the manager's probably going to be down. And so I have the downside protection to buffer against that decline in the benchmark. And so again, it's a two-way hedge. I'm hedging against manager underperformance on the upside, and I'm hedging against the market or the benchmark being down on the downside. Many questions I've received is saying, well, geez, if I'm getting downside protection and I'm getting enhanced upside, why wouldn't I put all of the exposure in the structured note or more than 30%? And that's your prerogative. You can certainly do that. But let me tell you why you shouldn't do that. Even though I have a vested interest to tell you why you should do that, you should not do that because, again, the terms of the structured notes only matter at maturity. It's not to say that Halo doesn't give you liquidity on a daily basis. We certainly do. And our clients utilize that almost every single day around the world. Now, the terms only matter at maturity. So using this as an example, let's say 3 years into the note, the S&P is up 100%. You're not going to be up 112. You still got another year left. It is a derivative in a zero coupon bond at the end of the day. It only matters at maturity. This note would probably be up around 105. So you'll likely still be outperforming the benchmark, but you're not going to get the full benefit of the participation until maturity. Now, there's reasons that you may still want to sell it, but what I always advise advisors is hold the structured note, plan to hold the structured note until maturity, and use your long equity as your cash toggle. So if a client has cash needs, you can use the long equity to pull from. If the client wants to tactically tilt up or down, you can use the long equity to tactically tilt up or down. That's what I did, and it worked very, very well for me. And so at the end of the day, structured notes don't need to be so complicated. Focus on the 4 variables of the maturity, the underlying, the payoff, the protection. Focus on the conversations with clients around defined outcomes and their desire for them. Focus with clients on their desire for downside investment protection. Ultimately, we feel the pain of losses twice as much as we do from the joy of gains. Feed into that, because portfolio management is just as much of an art than it is a science. And when utilizing structured notes correctly within the portfolio, not only can they help you better manage risk in your portfolio, you can have happier clients, and more importantly, you can use it as an incredible prospecting tool. There's a lot more to the allocation and to structured notes. I hope you found this helpful. But again, this is why we've got a full team of market specialists at Halo that can walk you through anything that you need. Or you can visit thejournal.haloinvesting.com, where we've got a wide variety of content, videos on the allocation strategy, and primers on structured notes to help your clients feel a little bit more comfortable using these products. I'm Jason Barsema. Thank you very much for watching, and we look forward to working with you shortly.